Today we're going to crack open a bit of a time capsule. We're going back, way back, 50 years in fact, to uncover some seriously powerful, timeless wisdom from a pretty unexpected source, a final letter Warren Buffett wrote as he was closing up his legendary first partnership.
So picture this, it's early 1970, and Buffett is sending his partners their final checks. He knows they're going to be looking for a new place to put that capital, so he decides to write them one last, detailed letter. And his goal? Man, it was ambitious. He wanted to basically distill a dense textbook of financial wisdom into something so clear and simple it could read like the Sunday comics.
Now, you'd probably expect a deep dive on some hot stocks, right? Or maybe a big prediction about the economy, but nope, you'd be wrong. He chose to write, of all things, about tax-free municipal bonds. Now, before you tune out, stick with me here, because the real lesson has almost nothing to do with bonds. It's a masterclass in a rational mindset that applies to, well, everything. So let's break down his first principle.
All right, so the very first principle that just jumps right off the page is the one he's most famous for. You absolutely have to understand what you're investing in. Before you can ever find value, you first have to find understanding. I mean, this is the Buffett philosophy in a nutshell. You see, his approach to figuring out if a bond issuer is creditworthy is exactly the same as his approach to analyzing a business for a stock purchase. If it's too complicated, if it requires a bunch of guesswork, he just puts it in the too hard pile and moves on. And he doesn't lose a wink of sleep over it.
And he gets super specific, He gives these concrete examples. He loves assets you can analyze with clear numbers, things like toll roads or power districts that have predictable revenue streams. He even calls out industrial bonds where a top-notch corporation like U.S. Steel is on the hook for the lease. But what he avoids is just as telling: the messy, politically complex finances of huge cities like New York or Chicago. For him, it's all about being a business analyst, not a speculator.
Okay, so this idea of understanding what you own, it flows right into his next huge point. You have to deeply understand the rules of the game, and you have to refuse to play if the whole thing is rigged against you. So, Buffett spends a ton of time in this letter talking about one specific feature he absolutely hates: the call provision. Let's just make sure we're all on the same page about what that is. A callable bond basically gives the issuer, the borrower, the right to pay you back early. They don't have to, but they can.
And this creates a classic heads I win, tails you lose situation for you, the investor. Think about it. If interest rates fall, that high coupon bond you're holding is suddenly a fantastic asset. So what happens? The issuer calls it away from you, and your big win disappears. But if interest rates rise, crushing the value of your bond, the issuer does absolutely nothing. You're just stuck with the loss. They hold all the cards.
His language here is blunt. He does not mince words. He calls agreeing to this kind of one-sided deal outrageous and the height of foolishness. He's just blown away that investors, and the dealers advising them, willingly sign up for these grossly unfair terms, day in and day out.
So the big question is, what were investors getting paid for taking on this massive one-sided risk? The answer is just astounding. Buffett saw that the extra yield being offered was basically nothing, zero. Investors were giving away an incredibly valuable option for free. And that's such a huge lesson, right? Always, always demand to be paid for the risks you're taking.
Okay, on to the third and final pillar from Buffett's masterclass. This one is all about using the market's own structure against it. It's about finding value where other people just see inconvenience, complexity, or maybe even tax problems.
So first off, he explains that the municipal bond market is, well, it's nothing like the stock market. It's this incredibly chopped up, illiquid world with hundreds of thousands of tiny, unique issues. He says the bid-ask spreads can be grotesque, and he's right. We're talking up to 15%. His advice? Stick to the big, easy-to-trade issues, and stay away from those small local bonds that dealers have the biggest incentive to sell you.
Now this is where it gets really juicy for a value investor. Buffett saw this massive opportunity in what are called discount bonds. So look at this example. A bond with a lower coupon has to sell for cheaper at a discount to give you a competitive yield. But that gain you get at maturity, that's taxable. Now that complexity, plus the fact that most people prefer higher cash payments right now, meant that most investors just ignored these things. But Buffett, he did the math, and he realized the higher total return more than made up for that future tax bill.
And here's the real kicker. This is the genius move. He figured out why this opportunity existed. A recent change in the tax law had basically kicked the single biggest buyers of these bonds, the banks, right out of that part of the market. And that created a huge supply and demand imbalance that gave smart individual investors who understood what was going on a major edge.
So what's the point of all this? Why are we dissecting a 50-year-old letter about boring municipal bonds? Because the underlying principles, man, they are absolutely timeless. They are universal. They're the bedrock of value investing itself.
And look, this wasn't just some theory he was kicking around. At the exact same time he was writing this bond letter, he was telling his brand new Berkshire Hathaway shareholders that his strategy was to buy businesses that met his strict investment and management criteria. He was using the very same playbook. Find understandable businesses with durable earning power at a fair price. The asset was different, sure, but the mindset was 100% identical.
So, when you boil it all down, these lessons from 1970 reveal the absolute core of the Buffett philosophy. Know what you own. Refuse to play a game you can't win. Use complexity and other people's biases as your advantage. And always, always do the math. It's a framework for making rational decisions that is just as powerful today as it was half a century ago.
So I'll just leave you with this question to think about. In today's world, a world of speed, with algorithms, with the next big thing, is it possible that the most powerful, most durable edge isn't in any of that? Maybe it's just having the patience and the discipline to apply these 50-year-old principles of risk, value, and human behavior?